All right, let's talk Stride Inc. This Q2 earnings report was a big one. Why? Well, after last quarter's, let's call it a disastrous tech rollout, this report was all about one thing, and one thing only: repairing credibility. So, did they pull it off? Let's get into it. So you gotta understand, this was the question hanging over everyone's head. The platform broke last quarter, badly, and that just created this huge cloud of doubt over the stock. So this earnings report, it was basically a make or break moment. Could management actually steer this ship back on course and win back some trust? That was the test. Okay, let's get right to the results snapshot. And the short answer is, yeah, they did. A decisive beat. From a numbers perspective, Stride came out swinging with a really strong quarter. It definitely caught the market off guard and went a long way toward calming those nerves about stability. Now, let's look at the headline numbers, because this is where it gets really interesting. It's not just that they beat expectations, it's how they beat them. See, revenue was up just a tiny bit, only about 0.5% over consensus. Fine. But look at the adjusted EPS. That's their profitability, right? They absolutely crushed it, a 24% beat. What that tells you is they're running the business really efficiently. They're squeezing more profit out of every single dollar of sales. And that, right there, is a huge sign of a healthy operation. And when you dig a little deeper, the story just gets better. Total enrollments up almost 8% from last year. Adjusted operating income up a solid 17%. But here's the number you really need to pay attention to. Career learning revenue up almost 25%. That is a monster number. You know, this is the part of their business that's going to push them beyond just K-12 education. It's their growth engine for the future, for sure. So, okay, the numbers look great. Check. But honestly, the financials weren't even the main event this quarter. No, this was all about addressing the elephant in the room, that broken platform from last time. It's really a story of crisis versus control. Last quarter was a complete mess, a disastrous tech rollout. This quarter was all about the cleanup. Management knew they had one job, and one job only: prove they could fix the system. This wasn't the time to talk about growth. It was about getting back in the driver's seat and, earning back that investor confidence they'd lost. And look, you don't have to take my word for it. The CEO, James Reu, said it point blank on the call. I think the bottom line is that we've executed on our plan and the core issues are behind us. That's a pretty definitive statement. And it wasn't just empty words. They actually brought the receipts, pointing to things like a 90% drop in support calls after they fixed a major login bug. That's tangible proof that, yeah, the crisis is really over. All right, so the fire's out, the platform is fixed. The natural next question is, what now? Let's look ahead and see what their guidance and the overall tone of the call can tell us about their strategy going forward. This is so important. They maintained their full-year guidance. They didn't lower it. Think about that. After a quarter where everything seemed to be falling apart, for them to come out and say, nope, we're sticking with our original plan for the year, that is a massive signal of confidence. It's them telling the market, we got this, the business is sound. And this really gets to the heart of their theme right now. The CEO made it crystal clear during the Q&A. He said, our goal this year is stability and not growth. They are deliberately not putting their foot back on the gas. And you know what? That's smart. They know that rushing into aggressive growth right now would be a huge mistake. The number one priority is proving they can run the ship smoothly quarter after quarter. That's how you build for the long term. So, that's the story management told: recovery, stability, and a whole lot of caution. But what did the ultimate judge, the market, think about all this? Well, the verdict came in loud and clear. Boom! The stock popped over 14% on January 28th. That's not just the market liking the results. That is the sound of a massive collective sigh of relief. This was investors voting with their wallets, saying, okay, we believe you. The worst is officially behind us. And check this out. This wasn't just a few people buying. The trading volume absolutely exploded. We're talking 6.7 million shares traded, compared to just 1.5 million the day before. That's a 4.5x increase. When you see a huge price jump on massive volume like that, it means there's real conviction behind the move. The big institutions, the so-called smart money, they were piling in. They saw this as a major de-risking event. Basically, the nightmare scenario was officially off the table. Okay, so credibility has been repaired, the stock has jumped. What does it all mean for what's next? This is where we get to our favorite part, the next call. All right, so here's our thesis for Stride. First up, next quarter's results. We're expecting something, well, solid. Not a blowout, but right in line with their guidance. Remember, they're all about stability, not growth right now. Second, the price action. After that huge pop, the stock's probably going to chill out for a bit, consolidate around these new levels while the market kind of digests everything. And all of that leads us to our final rating. And that rating is market perform. Look, they've done a fantastic job of getting out of the penalty box. They are back on neutral ground. The crisis is over. But, and this is a big but, that huge 14% jump in the stock has already priced in that good news. So the big question now is, can they keep it up? Can they prove that this new, stable execution is the new normal? Answering that question is what's going to drive the next big move in the stock.
And just as a reminder, this is not financial advice.